Welcome to this Q&A session for the New York Property and Casualty Insurance exam. These are real exam-style questions. We don't just reveal answers, we break down the reasoning behind every one. This video covers questions on insurance fundamentals and tort law, Homeowners Section 1 and 2, the personal auto policy, commercial property, crime and packages, New York law and the Superintendent. Quick reminder, our website offers free study guides and practice questions to help you pass your New York Property and Casualty exam. You'll find the link right down in the description below, so be sure to check it out and grab everything you need to start studying smarter, not harder today. Alright, let's dive in. 5. Question 1. A coal region miner develops a lung disease from years of dust exposure rather than from one sudden event. New York treats the date the disease disables the worker as what? Your options are A. The first day of employment, B. The date the claim is paid, C. The happening of an accident, D. A non-compensable event. Which one is it? Pause the video if you need more time. The correct answer is C. The happening of an accident. C is correct because for an occupational disease, New York treats the date of disablement as the happening of an accident. That mechanism fits a gradually developing illness into a framework built around sudden, traumatic injuries. I is wrong because the first day of employment is unrelated to when a slow developing disease becomes compensable. The law fixes the trigger at disablement, the point the illness stops the worker from earning full wages. B is wrong because the date the claim is paid is an administrative milestone that follows acceptance of the claim. It does not set the legal moment that an occupational disease is deemed to occur for benefit purposes. D is wrong because calling it non-compensable is wrong because New York covers essentially any disease of occupational origin. Dust exposure lung disease arising from the work is compensable once the worker is disabled by it. Workers' compensation was built for sudden accidents, a fall, a cut, a single datable moment. But some injuries develop silently over years, and the law needs a trick to give them a date. An occupational disease arises from conditions characteristic of the work itself. Things like dust in the lungs, hearing loss, or skin conditions from years of exposure. The defining feature is that the harm builds gradually with no single accident to point to. First exposure feels intuitive, but a worker can be exposed for decades and stay healthy, so that date triggers nothing. The payment date is just paperwork. Only disablement, the day the disease actually stops the worker from earning full wages, ties the legal trigger to real economic loss. Picture a machinist who breathes airborne particulate for decades. The condition sits quietly in the lungs for years while the worker keeps working full shifts, until breathing capacity finally drops and full-time work becomes impossible. That day of disablement is deemed the accident date, and the compensation clock starts there. A traumatic injury supplies its own date, but a disease creeping in over years does not. So the law manufactures one. Disablement stands in for the accident, folding slow motion harm into a framework built for sudden injuries. Question 2. New York rules require producers to keep their license available and to show it when a client or the department asks to see it. This obligation concerns what? Your options are A. Display of the license, B. Continuing education, C. Controlled business, D. Rebating. Take a second. Which answer would you pick? The correct answer is A. Display of the license. A is correct because producers must be able to display or produce their license on request, so clients and the regulator can confirm the person is properly authorized. This transparency supports public trust and oversight. B is wrong because continuing education is the recurring coursework required to renew a license. It keeps knowledge current but is separate from the duty to show the license itself when asked. C is wrong because controlled business limits writing coverage mainly on one's own interests. It restricts the producer's book of business and is unrelated to producing the license for inspection. D is wrong because rebating is an improper inducement to buy insurance. It is a sales practice violation and has nothing to do with the requirement to display a valid license on request. Every licensed profession relies on one guarantee: the public can verify that the person helping them is actually authorized. In New York insurance law, that guarantee has a name: the display of license rule. Think of the license like a badge a security guard must show the moment someone asks. A producer must keep the license available and produce it on demand from a client or from the Department of Financial Services. Picture a producer pulling out their license when a homeowner in Westchester wants reassurance, or when a DFS examiner in Albany conducts a market conduct review. The obligation isn't proving competence, it's proving on the spot that the credential exists. Exam writers love blending this with other producer duties that sound similar. Continuing education asks whether the producer's knowledge stays current. Controlled business asks whether the producer writes real outside coverage rather than mostly insuring themselves. Rebating asks whether the sale was won honestly without improper inducements. Display of license asks something narrower. Can the producer prove right now that the license exists? Keep that narrow focus, and the display duty never blurs into the broader rules about knowledge, business practice, or honest selling. Question 3. A Buffalo manufacturer's standard property and business owners forms exclude losses from boiler explosion and mechanical or electrical failure of machinery. Which separate coverage fills this gap? Your options are A. Commercial crime coverage, B. Inland marine coverage, C. Equipment breakdown coverage, D. Builder's risk coverage. Before I reveal it, which one do you think is right? The correct answer is C. Equipment breakdown coverage. C is correct because equipment breakdown coverage fills the gap left by the property and business owners forms, paying for loss caused by the sudden failure of boilers, pressure vessels, machinery, and electrical systems that those forms exclude. A is wrong because commercial crime coverage addresses theft, robbery, and employee dishonesty. It responds to criminal loss of money or property, not to the mechanical or electrical failure of the manufacturer's equipment. B is wrong because inland marine coverage insures movable or in-transit property under floaters. While broad, it is not the line designed to cover the internal breakdown of boilers and machinery. D is wrong because builder's risk coverage insures a structure while under construction, covering the building and its materials. It addresses construction period property risk, not the sudden failure of operating boilers and machinery at an established plant. Standard commercial property policies cover fire and windstorm, but they carve out one deliberate hole: sudden internal failure of pressurized and powered equipment. A boiler that ruptures, a motor destroyed by an electrical arc, a compressor that seizes. Property and BOP forms step back from these losses on purpose, leaving them for equipment breakdown coverage to pick up. Equipment breakdown coverage responds to internal failures like a ruptured boiler, an electrical arc, or a seized compressor, perils that originate inside the machine itself, unlike an external peril such as a windstorm. The trap is confusing equipment breakdown with its neighbors. Commercial crime covers theft and dishonesty. Inland marine covers movable property. Builder's risk covers property under construction, while equipment breakdown alone covers a machine that breaks down from the inside during ordinary operation. Equipment breakdown coverage exists because standard property forms exclude sudden internal failure. It buys back that exposure, backed by the insurer's own inspection and loss prevention engineering. Question 4. An owner asks how the National Flood Insurance Program limits coverage on a 1 to 4 family home. How does the program cap the building and the contents coverage? Your options are: A. There is a single combined limit. B. Coverage is unlimited for homes. C. Only the building can be insured. D. Separate maximum limits apply to each. What's your answer? Commit to one before I continue. The correct answer is D. Separate maximum limits apply to each. D is correct because the flood program sets separate statutory maximum limits for the building and for the contents of a residential dwelling. The two caps stand apart, so contents are insured in addition to the building, each up to its own limit. A is wrong because a single combined limit misstates the program, which caps the building and the contents under two distinct maximums. The insured must buy contents coverage separately rather than relying on one blended amount. B is wrong because coverage is not unlimited. The program caps residential building and contents at statutory maximums. An owner needing protection above those caps must seek excess flood coverage from another source. C is wrong because both the building and its contents can be insured under the program, each under its own limit. Saying only the building may be covered ignores the separate contents coverage the program provides. Flood insurance in the U.S. runs through a federal program with statutory limits, not private negotiation. For a 1 to 4 family home, that program splits coverage into two separate caps, one for the building, one for the contents. The building limit and the contents limit each have their own statutory ceiling, and neither shares from the other. Ensuring the structure does nothing for the belongings inside it, and ensuring the contents does nothing for the walls. So an owner who wants both must purchase both. That split exists because water damages a structure and its contents differently. Rising water attacks the foundation, systems, and lower levels of a building, while contents float, soak, and scatter separately. Exam writers love 3 wrong readings of this rule, assuming there's one combined limit, assuming coverage is unlimited, or assuming only the building can be insured. Each misconception ignores that the caps are separate, statutory, and both purchasable. Remember, federal flood coverage is 2 coverages under one program, each with its own lid. The building cap and contents cap are siblings, not a shared wallet. Question 5. New York's insurance industry is overseen by a single state department headed by an official who enforces the insurance law and regulates producers and insurers. Who is that official? Your options are: A. The insurance commissioner. B. The governor. C. The superintendent of financial services. D. The attorney general. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. The superintendent of financial services. C is correct because the Department of Financial Services regulates insurance in New York, and its superintendent administers and enforces the insurance law, oversees licensing, and supervises the conduct and solvency of insurers. A is wrong because New York no longer uses an insurance commissioner. The former insurance department was folded into the Department of Financial Services, and the superintendent now holds that regulatory authority. B is wrong because the governor appoints the superintendent but does not personally administer the insurance law or handle daily regulation of producers and insurers. That responsibility rests with the superintendent. D is wrong because the Attorney General handles legal matters for the state and may pursue fraud cases, yet that office does not run insurance licensing or supervise insurer solvency the way the superintendent does. Every state needs one accountable authority over its insurance market, and New York consolidated that power into a single office years ago. Knowing exactly where it sits and what it's called is foundational to the exam. This office is the Superintendent of Financial Services. The Superintendent administers and enforces the insurance law, licenses producers and adjusters, and supervises insurers for solvency and fair dealing across the state. Picture one office at the center of it all, with every regulatory duty branching outward from it. Whether it's a shaky balance sheet or a misconduct complaint, the same office examines it. The trap is a lineup of officials who each touch the system somewhere. The governor appoints the superintendent but doesn't run daily regulation. The attorney general prosecutes fraud but doesn't license or supervise solvency. Only the superintendent does both, day in and day out. New York once had an insurance commissioner, but that title vanished when the department merged into the Department of Financial Services. The authority didn't disappear. It moved to the superintendent, and that's the answer the exam is looking for. Question 6. An insured's own resident son is hurt while playing at the family home. The insured asks whether medical payments to others, coverage F, will pay the son's medical bills. What is the answer? Your options are A. Yes, coverage F pays all residents. B. Yes, but only above a deductible. So, yes, if the parent was at fault. D. No, coverage F excludes the insured's family. Which would you go with? Lock it in before the reveal. The correct answer is D. No, coverage F excludes the insured's family. D is correct because coverage F pays the medical expenses of persons other than an insured, so it does not cover the named insured or regular residents of the household. The insured's own resident son is excluded, making his injury a health insurance matter. A is wrong because coverage F covers others, not the insured's own household. It does not pay all residents. The named insured and resident family members are specifically excluded from this guest medical coverage. B is wrong because A, deductible is not the issue. The son is simply outside the class coverage F protects. Because resident family members are excluded, no payment is triggered for him, regardless of any deductible. C is wrong because fault is irrelevant to coverage F, which is no fault by design. Even if the parent were at fault, the resident son still falls within the household exclusion and cannot collect under medical payments to others. Coverage F, medical payments to others, is a small no-fault coverage with one big catch. It deliberately excludes the very family it seems to protect. This coverage pays reasonable medical bills for guests and visitors hurt on the property. No lawsuit or fault required. It's a fast, small dollar goodwill payment aimed strictly at outsiders, never at the named insured or the relatives who live in the household. Picture two children hurt in the same accident on the same porch. The visiting friend's bills get paid because she's an outsider, while the resident child's bills do not. Because he belongs to the insured household, the coverage was never meant to protect. It's tempting to blame a deductible or argue about fault, but neither applies here. The coverage isn't for every resident. Deductibles never enter the picture, and fault is irrelevant by design. The only thing that matters is household membership. When a resident is hurt at home, the right tool is the family's own health insurance, not coverage F. The policy isn't malfunctioning. It's doing exactly the job it was designed to do. Question 7. A renewability provision under which the insurer can neither cancel the policy nor change the guaranteed premium up to a stated age is the most protective for the insured. What is it called? Your options are non-cancelable, B, guaranteed renewable, C, conditionally renewable, D, optionally renewable. Don't overthink it. Which one feels right? The correct answer is A, non-cancelable. A is correct because under a non-cancelable provision, The insurer can neither cancel the policy nor change the premium, both the renewal right and the premium schedule being guaranteed to a stated age. It is the most protective renewability classification. B is wrong because guaranteed renewable means the insurer must renew to a stated age but may raise the premium by class. Because the premium can change, it is less protective than the non-cancelable classification described. C is wrong because conditionally renewable lets the insurer decline renewal on stated conditions unrelated to health and adjust premiums. The ability to non-renew on conditions makes it weaker than a non-cancelable policy. D is wrong because optionally renewable allows the insurer to refuse renewal at its option on renewal dates. That discretion to drop the policy is far less protective than a policy that can neither be cancelled nor repriced. Renewability provisions sit on a spectrum from total insurer control to near total insured protection, and one classification sits above all the others. Non-cancelable is the most protective classification because it guarantees two things at once. The insurer cannot cancel the policy and cannot raise the guaranteed premium up to a stated age. Picture the policy secured by two padlocks, one guaranteeing renewal, the other locking the premium in place, together closing every door the insurer could otherwise use to push the policy owner out. Compare the four classifications by how much power the insurer keeps. Non-cancelable guarantees both renewal and price. Guaranteed renewable locks only the renewal while premiums can rise by class. Conditionally renewable lets the insurer decline renewal on stated conditions. And optionally renewable leaves renewal entirely to the insurer's discretion. The fewer levers the insurer retains, the stronger the insured's position, and non-cancelable is the only classification that strips away both the cancellation lever and the pricing lever. Question 8. After a theft at a home in Manhattan, the insured wants to protect the right to recover under the policy. Which action is one of the insured's required duties after a loss? Your options are A. Wait until renewal to report it. B. Repair everything before notifying anyone. C. Refuse to show the damaged property. D. Give prompt notice and notify the police. Got a guess? Lock it in. The correct answer is D. Give prompt notice and notify the police. D is correct because after a loss, the insured must give prompt notice to the insurer and, in a theft, notify the police. The insured must also protect the property, prepare an inventory, and submit a signed, sworn proof of loss within the required time. A is wrong because waiting until renewal violates the duty to give prompt notice of a loss. Delaying the report that long can jeopardize the claim. So postponing notice is the opposite of what the conditions require. B is wrong because the insured must protect property from further damage but should not complete full repairs before notifying the insurer. The insurer has a right to inspect, so repairing everything first can impair the claim. C is wrong because refusing to exhibit the damaged property breaches a duty after loss. The insured must show the property, cooperate, and submit to examination, so declining to display it works against recovery. A property loss doesn't end the policyholder's obligations. It starts a list of duties that must be performed correctly for the claim to survive. The core duties are giving prompt notice, protecting the property from further harm, preparing an inventory and exhibiting the damage, and submitting a sworn proof of loss within the required time, with an added duty to notify the police in a theft. Think of the claim itself as a file the insurer must verify, stamped with prompt notice, an inventory, a sworn proof of loss, and, in a theft, a police report, each piece giving the insurer a fair chance to investigate. The trap is confusing convenience with compliance. Waiting to report a loss breaks the prompt notice duty. Repairing damage before notifying the insurer destroys evidence it has a right to inspect. and refusing to show the damaged property breaks the duty to cooperate. A policy is a conditional promise. Coverage depends on the insured performing these post-loss duties, and treating them as optional can make the contract's protection evaporate. Question 9. A business owner's endorsement makes the insured's upkeep of a sprinkler system or burglar alarm a condition of coverage. An unreported outage can forfeit a loss. Which endorsement is this? Your options are A. Protective safeguards, B. Utility services time element, C. Hired and non-owned auto, D. Equipment breakdown. Which one is it? Pause the video if you need more time. The correct answer is A. Protective safeguards. A is correct because the protective safeguards endorsement makes maintaining listed devices, such as a sprinkler system or burglar alarm, a condition of coverage. The insurer will not pay a fire or burglary loss if the safeguard was not maintained or a known impairment went unreported. B is wrong because the utility services time element endorsement covers lost income from an off-premises utility interruption. It addresses utility outages, not a requirement to keep sprinklers or alarms in working order. C is wrong because the hired and non-owned auto endorsement restores auto liability for vehicles used in the business. It concerns drive and exposures, not the upkeep of fire or burglary protective devices. D is wrong because equipment breakdown covers physical damage from machinery and boiler failure. It is a property coverage for breakdowns, unrelated to conditioning coverage on maintaining protective safeguards. Some commercial endorsements convert a discount into a duty. Here's how the protective safeguards endorsement turns maintenance into a condition of coverage. The insured agrees to keep listed safeguards like a sprinkler system or burglar alarm in working order. In return, the insurer offers a rate credit, but that credit comes with an affirmative duty: report any known impairment immediately or risk losing coverage entirely. Picture a warehouse protected by an automatic sprinkler system and a burglar alarm, the exact devices this endorsement names. The insurer priced the risk assuming both are active, so a shut valve or a dead alarm silently changes the real risk being covered. Other endorsements look similar but do different work. The utility services time element covers off-premises utility outages. Hired and non-owned auto covers vehicles the business doesn't own, and equipment breakdown covers machinery failure. Only protective safeguards conditions coverage on maintaining named devices. Remember, the rate credit is earned, not free. Let a safeguard lapse and stay silent, and a fully paid policy can still leave a real loss denied. Question 10. A covered fire makes a family's home in Westchester unfit to live in, forcing them into a hotel and restaurant meals during repairs. Which coverage pays the necessary increase in living expenses? Your options are A. Coverage A, dwelling, B. Coverage C, personal property, C. Coverage D, loss of use, D. Coverage F, medical payments. Take a second. Which answer would you pick? The correct answer is C. Coverage D, loss of use. C is correct because coverage D, loss of use, pays the necessary increase in living expenses, called additional living expense, when a covered peril makes the home unfit to live in. It covers the extra cost of maintaining the household's normal standard of living. This is wrong because coverage A pays to repair or rebuild the damaged dwelling itself. It addresses the structure, not the family's hotel and meal costs while displaced, which are handled by the loss of use coverage instead. B is wrong because coverage C insures personal belongings damaged by a covered peril. The extra hotel and restaurant costs are living expenses, not damaged property, so personal property coverage is not the right part here. D is wrong because coverage F pays medical expenses of others injured at the home, regardless of fault. It has nothing to do with displacement costs, so it cannot pay the family's increased living expenses during repairs. When a fire or other covered peril leaves a home unlivable, one coverage handles a cost most people never think about, the price of living somewhere else. Coverage D pays the necessary increase in living expenses when a covered peril makes a home unfit to live in, covering things like hotel bills and restaurant meals above what the family normally spends. The key word is increase. It reimburses only the extra cost caused by the loss, not the household's whole budget. Picture a home damaged by fire. The structure itself falls under coverage A, while the displaced family, now paying for a hotel and meals out, faces increased living costs that coverage D reimburses above their normal everyday spending. Each coverage handles a different piece of the same loss. Coverage A repairs the dwelling. Coverage C protects damaged belongings. Coverage F pays a guest's medical bills regardless of fault. And coverage D alone is about being displaced from the home itself. Loss of use ensures the consequence of the loss, not the loss itself. Confusing the two means confusing the cost of the building with the cost of being kept out of it. Question 11. The department periodically inspects an insurer's financial records and market conduct to confirm compliance with New York law. What is this regulatory review generally called? Your options are A. An audit appointment. B. An examination of books and records. C. A rate filing. D. A market binder. Before I reveal it, which one do you think is right? The correct answer is B. An examination of books and records. B is correct because the superintendent may examine an insurer's books, records, and conduct to verify financial condition and compliance. These examinations are a core supervisory tool for catching problems before policyholders are harmed. A is wrong because audit appointment is not a recognized regulatory term in this context. The department's review of a company's records is called an examination, conducted under the superintendent's statutory authority. C is wrong because A rate filing is the submission of proposed premium rates for review. It deals with pricing approval, not the broad inspection of an insurer's records and market behavior. D is wrong because market binder is not a real regulatory mechanism. A binder provides temporary coverage to an insured, which is unrelated to the department's authority to inspect company records. Regulators can't just take an insurer's word that it's solvent. New York gives the superintendent the power to look inside the company directly, on-site and on demand. This examination is a formal, on-site review where the superintendent inspects an insurer's records and behavior, checking how reserves are set, how claims are handled, and how policies are sold, all to confirm the company is financially sound and law-abiding. It's easy to confuse this with sound-alike terms. A rate filing is just the superintendent reviewing proposed premium prices. A binder is temporary proof of coverage issued to a policyholder, unrelated to regulation. Only the examination actually inspects the insurer's books and market conduct to verify solvency. Picture examiners arriving on site at an insurer's office, reviewing its accounts, reserve calculation, and claims files firsthand, to catch a problem like shrinking reserves before policyholders ever feel the shortfall. Remember, a rate filing checks price and a binder proves coverage, but only the examination checks whether the insurer can actually keep its promises. Question 12. A homeowner in Rochester carries dwelling coverage equal to at least 80% of the home's replacement cost. After a covered partial loss to the building, how is the loss generally settled? Your options are A. At replacement cost without depreciation. B. Always at actual cash value. C. At market value of the home. D. At the salvage value of the parts. What's your answer? Commit to one before I continue. The correct answer is A, at replacement cost without depreciation. A is correct because when the insured carries at least 80% of the dwelling's replacement cost, covered partial losses to the building are paid at replacement cost with no deduction for depreciation, up to the policy limit, once the insured repairs or rebuilds. B is wrong because actual cash value applies when the insured fails to carry the required 80% or to certain non-building items. Because this owner meets the threshold, the dwelling is settled at replacement cost instead. C is wrong because market value reflects what a buyer would pay and includes land and location. The dwelling loss settlement is based on the cost to repair or rebuild, not on the property's market value. So this is incorrect. D is wrong because salvage value is what damaged remnants are worth, not the basis for settling a covered building loss. Meeting the coinsurance threshold entitles the insured to replacement cost far more than salvage. Replacement cost coverage sounds like a generous promise, but insurers only pay it in full when a key coinsurance condition is satisfied. The mechanism is coinsurance. Carry dwelling coverage equal to at least 80% of replacement cost, suffer a covered partial loss, and actually repair or rebuild, and the insurer pays full replacement cost with no deduction for depreciation. Picture a Rochester homeowner insured to 90% of replacement cost when fire damages part of the dwelling. Because the threshold is met and the owner rebuilds, the insurer pays full repair cost with no deduction for age or wear. The confusable measures each value a loss differently. Replacement cost pays full rebuild expense. Actual cash value subtracts depreciation. Market value reflects what a buyer would pay including land. And salvage value is only what damaged remnants are worth. Meet the 80% threshold. Rebuild the property and replacement cost is earned. Fall short and a coinsurance penalty pushes the payout back toward actual cash value. Question 13. A personal umbrella insured warrants that she will keep her required underlying homeowner's liability in force. She lets it lapse, then has a covered loss. What does the umbrella do? Your options are: A. Pays the entire loss in full. B. Pays nothing toward the loss. C. Cancels automatically without notice. D. Pays only as if underlying were maintained. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. Pays only as if underlying were maintained. D is correct because if a required underlying policy lapses, the umbrella pays only what it would have paid had the underlying coverage been maintained. The insured personally absorbs the gap created by the missing primary layer. A is wrong because paying the entire loss would let the insured benefit from failing to keep the required underlying coverage. The umbrella deliberately refuses to fill the gap left by the lapsed primary policy. B is wrong because paying nothing overstates the consequence. The umbrella still responds to amounts above the underlying limit that should have existed. Only the gap left by the missing primary layer falls to the insured. C is wrong because automatic cancellation is not the result of a lapsed underlying policy. The umbrella remains in force but simply limits what it pays, treating the underlying as if it had been kept at required limits. An umbrella policy is excess liability coverage that sits above a home owner's or auto policy, paying catastrophic losses only after the primary limit is exhausted. That design only works if the insured keeps the underlying policy in force. The umbrella is priced as pure excess coverage, assuming a primary policy absorbs the smaller, frequent losses first. To protect that pricing, the insured warrants to maintain the required underlying limits for the umbrella's full term, or risk paying the gap themselves. Picture the layers stacked, the required underlying limit at the bottom, the umbrella above it, and a gap that opens when the primary lapses. A large loss then falls partly into that gap, which the insured alone must cover. Two extreme readings are wrong. Paying the loss in full would reward the lapse, while paying nothing ignores that the umbrella still owes everything above where the underlying should have sat. The correct outcome is that the umbrella pays exactly as if the underlying had been maintained. The umbrella never terminates from a lapse. It simply refuses to drop down, leaving the insured to absorb the unfilled gap. Question 14. A customer slips on a freshly waxed floor inside an Albany store and is injured, and the store is held liable. Which commercial general liability coverage pays these damages? Your options are A. Coverage B. Personal and advertising injury. B. Coverage C. Medical payments. C. Coverage of bodily injury and property damage. D. Supplementary payments only. Which would you go with? Lock it in before the reveal. The correct answer is C. Coverage A. Bodily injury and property damage. C is correct because coverage A pays sums the insured becomes legally obligated to pay as damages for bodily injury or property damage caused by an occurrence. A customer's injury from a slip and fall, the store is liable for falls squarely here. A is wrong because coverage B responds to offences against reputation, privacy, and advertising, such as libel or slander. A physical injury from a fall is bodily injury, which belongs under a different coverage entirely. B is wrong because coverage C pays small medical bills without regard to fault, but the scenario states the store is legally liable for damages. Liability damages exceed the fast pay, goodwill purpose of medical payments. D is wrong because supplementary payments cover extras like defense costs and bail, paid in addition to the limits. They support a claim but are not the coverage that pays the injured customer's actual damages. Every commercial general liability policy divides risk into distinct parts, and the exam wants you to route each injury to the correct one. Coverage A pays sums the insured is legally obligated to pay as damages caused by an occurrence, plus the insurer's duty to defend the suit. Coverage B handles personal and advertising injury like libel or slander. Coverage C pays small medical bills regardless of fault, and supplementary payments cover extras like defense costs alongside the limit. Picture a customer who slips on a freshly waxed floor in an Albany store and is injured, and the store is found legally liable. The damages themselves are paid under coverage A, while the store's defense costs are handled separately as supplementary payments. When physical harm meets legal liability, the answer is coverage A, the heart of the policy. Question 15. Before exporting a New York risk to an unauthorized insurer, the excess line broker must generally show the coverage was unavailable from the admitted market. New York standard requires what? Your options are A. Single declination by letter. B. Approval from the governor. C. A lower premium quote. D. Declinations from 3 authorized insurers. Don't overthink it. Which one feels right? The correct answer is D. Declinations from 3 authorized insurers. D is correct because New York's diligent effort standard generally requires declinations from 3 authorized insurers before a risk may be exported, documented in a sworn affidavit. Listed export list coverages are exempt from this declination search. A is wrong because a single declination falls short of the rule. The broker must ordinarily obtain 3 declinations from authorized insurers that might consider the risk, then memorialize that effort in an affidavit. B is wrong because approval from the governor plays no part in excess line placement. The diligent effort showing runs through declinations and an affidavit, not through any sign-off by the state's chief executive. C is wrong because a lower premium quote is irrelevant because excess line exists for availability, not price. Coverage may not be exported merely to obtain a cheaper rate than the admitted market offers. Before a risk can leave New York's regulated insurance market, the law demands proof that no licensed insurer would take it. The excess line broker must show a diligent effort, declinations from 3 authorized insurers, all documented in a sworn affidavit before the risk can be exported. That effort takes a specific documented form, a sworn affidavit listing each authorized insurer approached and their declination, with 3 refusals required unless the coverage sits on the state's export list. Exam traps often shrink or replace the standard. A single declination isn't enough. The governor's approval has nothing to do with excess line placement, and a lower premium quote never justifies exporting a risk the admitted market would still write. Strip away the distractors and remember the core rule: 3 declinations, 1 affidavit, and price never enters the equation. Question 16. A homeowner from Albany has a suitcase of clothing and a camera stolen from a hotel while traveling overseas. Why might the homeowner's policy still respond to this loss? Your options are: A. Coverage C insures property worldwide. B. Coverage C applies only at home. C. Theft abroad is never covered. D. Only coverage A would respond. Got a guess? Lock it in. The correct answer is A. Coverage C insures property worldwide. A is correct because coverage C insures personal property owned or used by an insured anywhere in the world. This worldwide scope means belongings are covered whether they are in the home, in a car, or on a trip abroad, subject to policy terms. B is wrong because limiting coverage C to the home ignores its worldwide feature. Personal property is protected away from the resident's premises too, though an off-premises sublimit may reduce the amount available for such losses. C is wrong because theft is a covered peril under every homeowner's form, and the worldwide scope of coverage C extends it beyond the home. Saying theft abroad is never covered contradicts how personal property coverage works. D is wrong because coverage A insures the dwelling structure, not movable belongings. A stolen suitcase and camera are personal property, so coverage C, not the dwelling coverage, is the part that would respond here. Personal property coverage travels with you. One of the most useful, most overlooked features of a homeowner's policy is exactly how far that protection reaches beyond the front door. Coverage C insures personal property wherever it happens to be, sitting at home in Albany, packed in a car, or carried on a trip overseas, subject to the policy's terms and limits. The coverage follows the property and the insured, not the residents. This nuance matters. Worldwide coverage isn't unlimited coverage. An off-premises sublimit often caps the amount available for property away from home at a percentage of the coverage C limit. So whether a loss is covered and how much it pays are 2 separate questions. Exam traps go both ways. Some answers wrongly limit coverage C to the home, deny theft abroad, or misroute the loss to coverage A, which only insures the dwelling structure, not movable belongings. Others wrongly assume coverage is unlimited everywhere, ignoring the off-premises sublimit. Picture the homeowner from Albany robbed overseas. The loss is covered because theft is a covered peril, and coverage C reaches worldwide, but the payout may be reduced by the off-premises sublimit. Question 17. When a producer seeks a non-resident license, New York looks to the state where the producer keeps a principal residence or place of business and holds a resident license. What is that state called? Your options are A. The domiciliary state, B. The admitted state, C. The home state, D. The reciprocal state. Which one is it? Pause the video if you need more time. The correct answer is C, the home state. C is correct because the home state is where a producer keeps a principal residence or principal place of business and holds a resident license. Non-resident licensing in other states keys off that home state status. A is wrong because domiciliary state describes where an insurer, not a producer, is organized and headquartered. The term applies to classifying companies as domestic, foreign, or alien rather than to a producer's residency. B is wrong because admitted refers to an insurer that holds a certificate of authority to operate in a state. It describes a company's authorization status, not the residency concept used for non-resident licensing. D is wrong because reciprocal can describe an insurer type or an arrangement between states, but it is not the defined term for a producer's principal residence used to grant a non-resident license. Multi-state producer licensing works like a hub-and-spoke system. One state anchors the producer's license, and every other state simply refers back to it. Getting this vocabulary right is crucial since the exam loves near synonym traps. The home state is where a producer actually lives or runs their business and holds a resident license. It's the true regulatory anchor, and every non-resident license elsewhere is keyed off this one home state relationship. Three insurer terms often masquerade as producer concepts. Domiciliary describes where an insurer is organized and headquartered. Admitted means an insurer holds a certificate of authority to operate. And reciprocal can describe an insurer type or a state-to-state arrangement. None of these describe a producer's residence. Picture a producer based in Buffalo, holding a New York resident license, who wants to write business next door. The neighboring state treats New York as the home state, issuing a non-resident license keyed directly to that resident license and standing. Keep the line clean. Home state belongs to the producer, while domiciliary, admitted, and reciprocal belong to the insurer. Remember that split, and the near synonyms lose their power to trick you. Question 18. A homeowner in Nassau County employs a full-time housekeeper who works well over 40 hours each week. New York requires what kind of protection for this residence employee? Your options are A. No coverage of any kind. B. Mandatory workers' compensation coverage. C. Only personal liability coverage. D. Flood coverage on the residence. Take a second. Which answer would you pick? The correct answer is B. Mandatory workers' compensation coverage. B is correct because in New York, a residence employee who works 40 or more hours per week must be covered by workers' compensation. The homeowner's workers' compensation endorsement for certain residence employees provides this mandatory statutory coverage within the policy. A is wrong because a full-time residence employee triggers mandatory workers' compensation in New York, so no coverage is not an option. Failing to provide it would leave the homeowner out of compliance with state law. C is wrong because personal liability under coverage E addresses the insured's legal liability to others, not an injured employee's statutory benefits. Workers' compensation, not liability coverage, is what New York mandates for this worker. D is wrong because flood coverage protects the building and contents against rising water, an entirely different exposure. It does nothing for an employee's injury, which New York law requires be addressed through workers' compensation. New York treats workers' compensation as a near universal mandate, and that mandate can reach right into a private home. When household help crosses a certain threshold, the homeowner becomes a statutory employer with a coverage duty. A residence employee performs duties tied to maintaining or using the home, like a housekeeper, nanny, or groundskeeper. Once that person works 40 or more hours a week, New York requires the homeowner to secure workers' compensation, a statutory duty that can't be declined, typically added through a homeowner's policy endorsement. Picture the homeowner's policy itself. Coverage. E handles the homeowner's liability to others, while a separate workers' compensation endorsement handles injuries to a resident's employee. Crossing the 40-hour threshold is what activates that endorsement's statutory benefits. Saying no coverage is required ignores the mandatory threshold. Pointing to coverage, E confuses liability for fault-based claims with no-fault workers' compensation. And flood coverage addresses rising water, not an employee's injury, so it's simply unrelated. An injured resident's employee is entitled to no-fault statutory benefits, not a liability award. That's the protection New York mandates once weekly hours cross the threshold, and it's why liability coverage, however useful elsewhere, isn't the answer here. Question 19. Property forms often suspend perils such as vandalism and glass breakage once a building has sat empty of people and contents beyond a set period. Why is that empty condition treated as riskier? Your options are A. An unwatched empty building invites loss. B. Empty buildings cannot be insured. C. Vacancy voids the entire policy. D. Vacant buildings never depreciate. Before I reveal it, which one do you think is right? The correct answer is A. An unwatched empty building invites loss. A is correct because an empty, unwatched building is far more exposed to vandalism, undetected water escape, and forced entry. So coverage for those perils drops away after the building has been vacant beyond the stated period. B is wrong because vacant buildings can still be insured, sometimes with a special endorsement, so it is untrue that they cannot be covered. The forms suspend only certain perils, not the possibility of insurance altogether. C is wrong because prolonged vacancy suspends specific perils such as vandalism and glass breakage, but it does not wipe out the entire policy. Other covered causes of loss generally continue to apply despite the vacancy. D is wrong because depreciation reflects age and wear and continues regardless of occupancy, so saying vacant buildings never depreciate is simply false. The real reason for the penalty is the heightened exposure of an empty structure. Property insurance quietly changes when a building sits empty too long, and understanding why matters more than just memorizing that it happens. Once a building has been vacant beyond a stated period, often 60 consecutive days, the property form suspends coverage for vandalism, glass breakage, and certain water damage, and may cut other recoveries by a percentage. The reasoning is simple. People prevent losses just by being present. Occupants notice smoke, hear breaking glass, and shut off leaking water before damage spreads. Remove the occupants and an unwatched building invites loss. Vandals work undisturbed. A burst pipe can leak for weeks unnoticed, and forced entry goes undetected. The penalty is often misunderstood. Vacant buildings can still be insured. Sometimes with a special endorsement, vacancy doesn't void the entire policy, only specific perils, and depreciation has nothing to do with it. The true reason is heightened exposure to loss. Question 20. After a covered fire closes a Rochester restaurant, one commercial property coverage pays its lost net income and continuing expenses during the period the property is being repaired. Which coverage is this? Your options are A. Extra expense coverage, B. Legal liability coverage, C. Spoilage coverage, D. Business income coverage. What's your answer? Commit to one before I continue. The correct answer is D. Business income coverage. D is correct because business income coverage is a time element coverage paying lost net income plus continuing normal operating expenses, including payroll, during the period of restoration after a covered loss, suspends operations at the described premises. A is wrong because extra expense coverage pays the additional cost of staying open or speeding reopening, not the lost income itself. A business needing replacement of lost earnings looks to business income instead. B is wrong because legal liability coverage pays for damage to property of others in the insured's care only when the insured is legally liable. It does not replace the restaurant's own lost earnings during a shutdown. C is wrong because spoilage coverage addresses loss to perishable stock under controlled conditions, such as refrigerated goods. It protects specific inventory, not the broad loss of income while the business cannot operate. When a covered loss shuts a business down, the repair bill is only half the story. The lost income during the closure can be the bigger loss. Business income coverage is a time element coverage that pays the net income the business would have earned, plus continuing normal operating expenses like rent and payroll, for as long as the period of restoration lasts. Picture a restaurant closed for 3 months after a covered kitchen fire. Business income coverage pays the net income it would have earned, plus its continuing rent and payroll through that period of restoration. Other coverages respond to the same shutdown but do different jobs. Extra expense pays added costs of staying open. Legal liability covers damage to others' property when the insured is at fault. And spoilage protects perishable stock like refrigerated goods. Business income alone replaces the lost earnings and continuing expenses. The signal is simple. Lost net income plus continuing operating expenses during the period of restoration always points to business income coverage. Question 21. A policyholder wants to transfer his existing policy to the person buying his property. Because the insurer underwrote this particular insured, what does the policy require first? Your options are A. A new declarations page. B. The insurer's written consent. C. A short rate refund. D. A higher deductible. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. The insurer's written consent. B is correct because a policy may not be transferred to another party without the insurer's written consent, because the insurer underwrote the specific insured rather than a stranger. This is the assignment condition. A is wrong because a new declarations page records changed facts, but does not authorize handing the contract to a different person. Transferring the policy to the buyer requires the insurer's written consent first. C is wrong because a short rate refund applies when the insured cancels early and the insurer keeps a penalty. It deals with returning premium on cancellation, not with assigning the policy to a buyer. D is wrong because a higher deductible changes the insured's out-of-pocket share on losses. It adjusts pricing and risk sharing and has nothing to do with the consent needed to transfer the policy. Insurance policies are personal contracts, not transferable deeds. Let's explore why assignment requires the insurer's written consent. When the insurer set the premium, it assessed this particular applicant, the moral and physical hazards they present, and their loss history. A buyer of the property is an unknown quantity the insurer never evaluated or priced. Picture a homeowner selling a house and hoping the buyer can simply take over the existing policy. The insurer underwrote the seller, not the buyer, so it must approve the new owner before agreeing to insure them. And without that written consent, the assignment is ineffective. The trap answers describe real policy mechanics that solve different problems. A new declarations page just records changed facts. A short rate refund only returns premium on early cancellation, and a higher deductible merely adjusts the insured share of losses. None of these authorize transferring the contract to a new party. The insurer chose this insured, so this insured cannot unilaterally swap in another. Only the insurer's written consent can transfer the policy. Question 22. A fire damages a home and its attached garage in Rochester. Which Section Y coverage applies to the dwelling and the structures attached to it? Your options are A. Coverage B. Other structures. B. Coverage C. Personal property. C. Coverage A. Dwelling. D. Coverage D. Loss of use. Which would you go with? Lock it in before the reveal. The correct answer is C. Coverage A. Dwelling. C is correct because Coverage A insures the dwelling on the resident's premises and structures attached to it, such as an attached garage, along with construction materials on the premises. Attachment is the key that places the garage under Coverage A. A is wrong because Coverage B insures other structures separated from the dwelling by clear space, like a detached shed. Because the garage in this case is attached, it belongs under the dwelling coverage rather than other structures. B is wrong because Coverage C insures personal property, the movable belongings of the insured. A garage that is part of the building is real property, not contents. So this coverage does not apply to the structure itself. D is wrong because Coverage D, loss of use, pays the indirect costs of being unable to live in a damaged home. It does not pay for the physical damage to the dwelling or attached garage, which is Coverage A's role. Homeowners policies split property into categories, and the line between the dwelling and everything else comes down to one physical fact: attachment. This boundary is the key to understanding Coverage A, the dwelling coverage. Coverage A insures the dwelling itself, along with structures attached to it, such as an attached garage, porch, or deck, plus materials and supplies on site for construction or repair. The test is not what the structure is used for, but whether it touches the house. Picture a house with a garage built onto its side, sharing walls and a roofline, because it's attached. Both are insured under Coverage A. If that same garage stood freestanding across the driveway, separated by clear space, it would fall under Coverage B instead. Coverage B handles other structures separated by clear space like a detached shed or fence. Coverage C covers personal belongings, not the building itself. And Coverage D pays the extra living costs while a damaged home is being repaired. A garage is a garage either way, but its coverage flips on connection alone. Ask first whether the structure is attached to the dwelling, and the correct coverage follows. Question 23. The most common basis for paying property losses takes today's cost to replace an item and then subtracts depreciation for age and wear. Which valuation method does this describe? Your options are A. Replacement cost, B. Actual cash value, C. Agreed value, D. Market value. Don't overthink it. Which one feels right? The correct answer is B. Actual cash value. B is correct because actual cash value is today's replacement cost reduced by depreciation for age, wear, and obsolescence. It is the default basis for most property losses and uses current replacement cost, not the original price. A is wrong because replacement cost pays the full cost to repair or replace with like kind and quality and takes no deduction for depreciation. Because it skips the depreciation subtraction, it is more generous than the method described. C is wrong because agreed value is a figure set before issuance and guaranteed at total loss, used for hard-to-value items. It does not subtract depreciation from a current replacement cost the way this method does. D is wrong because market value is the price a willing buyer would pay a willing seller and bundles in land and location. Insurers rarely use it because it does not reflect the cost to rebuild minus depreciation. Most property claims aren't paid at the original purchase price or the cost of a brand new replacement. Instead, they use a default method called actual cash value. Actual cash value starts with today's cost to replace the item. then subtracts depreciation for age, wear, and obsolescence. This keeps the payout aligned with the principle of indemnity, restoring the insured to their prior position, not better. Replacement cost pays full new for old value with no depreciation deduction. Agreed value is fixed before the policy is issued for hard-to-value items. Market value reflects what a buyer would pay, including land and location. Only actual cash value combines current replacement cost with a depreciation subtraction. Picture a several-year-old furnace destroyed by a covered loss. The insurer prices a comparable new furnace today, then subtracts depreciation for the years already used, leaving the actual cash value paid to the insured. Whenever a question describes paying today's replacement cost and then subtracting depreciation, that's the unmistakable signal for actual cash value. Question 24. A driver in Buffalo is at fault in a collision and injures the occupants of the other car and damages their vehicle. Which part of the personal auto policy pays those third-party claims? Your options are A. Part B, medical payment. B. Part C, uninsured motorists. C. Part D, damage to your auto. D. Part A, liability coverage. Got a guess? Lock it in. The correct answer is D. Part A, liability coverage. D is correct because Part A, liability coverage, pays damages for bodily injury or property damage to others for which an insured is legally responsible in an auto accident. It responds to the injured occupants and the damaged vehicle of the other party. A is wrong because Part B pays medical expenses for the insured and the occupants of the insured's own car, regardless of fault. It does not pay the other party's claims, which fall under the liability coverage instead. B is wrong because Part C protects the insured when an at-fault driver is uninsured or underinsured. It is first-party protection for the insured side, not coverage for damage the insured causes to other people. C is wrong because Part D pays for physical damage to the insured's own covered auto. It addresses the insured's vehicle, not the bodily injury and property damage suffered by the other party in the crash. Every auto policy claim can be routed to a lettered part, and the part that protects other people on the road is Part A, liability coverage. Part A pays damages for bodily injury or property damage that an insured causes to others in an auto accident. It's third-party coverage. It compensates the victim while shielding the insured's own assets, and it even funds a legal defense. The rest of the policy faces the other direction. Part B pays medical bills for the insured's own car regardless of fault. Part C protects the insured when the other driver is uninsured, and Part D covers damage to the insured's own vehicle. Only Part A pays the other party for harm the insured caused. Picture an at-fault driver in Buffalo who crashes into another car, injuring its occupants and crumpling the vehicle. Part A steps in, paying the injured occupants and the cost of the other car up to policy limits, while the insured's own injuries and vehicle are handled elsewhere. Whenever a stem shows an at-fault insured harming another person's body or property, that third-party direction of loss is the signal for Part A, liability coverage. Question 25. A Nassau County landlord's insured rental house is damaged by a covered peril and cannot be rented for 3 months. Which coverage replaces the rent the owner loses? Your options are A. Additional living expense. B. Personal property. C. Fair rental value. D. Medical payments. Which one is it? Pause the video if you need more time. The correct answer is C. Fair rental value. C is correct because fair rental value pays the rental income the owner loses when a covered loss makes rented or held for rent space unfit for use. It addresses income to the owner while the damaged unit cannot be rented. A is wrong because additional living expense covers an owner-occupant's extra living costs when displaced from a home they live in. The landlord does not live in the rental, so the coverage for lost rent is fair rental value instead. B is wrong because personal property covers the insured's belongings, not lost rental income. It would respond to damaged furnishings the landlord owns, but it does not replace the rent the owner cannot collect. D is wrong because medical payments covers others' medical expenses after an injury and exists only when liability coverage is added. It has nothing to do with replacing rental income lost while the unit is unrentable. When a covered loss damages a rental property, the owner loses more than a building to repair. The rent stops too. That specific loss is answered by fair rental value. Fair rental value pays the rental income an owner loses when a covered loss makes rented or held for rent space unfit for use. It covers the period the unit sits empty during repairs, and it is strictly about the landlord's lost cash flow, never about anyone's living comfort. Additional living expense covers an owner-occupant's extra living costs when displaced from a home they live in. Personal property covers the landlord's own belongings like furnishings, not lost rent. Medical payments covers others' injuries when liability coverage applies. Fair rental value alone replaces the rent a landlord loses. Picture a landlord whose insured rental house is damaged by a covered peril and can't be rented for 3 months while it's repaired. Fair rental value pays the rent lost over those 3 months, the income the property would have earned had it stayed rentable. Whenever a stem describes a landlord unable to collect rent while a unit is repaired, the signal points straight to fair rental value, the coverage for the one who rents it out, not the one who lives there. Question 26. A New York client buys excess line coverage from an unauthorized insurer. The broker must give a disclosure warning the client about which key loss of protection. Your options are A. No state guarantee fund protection. B. No coverage for fire losses. C. No ability to file claims. D. No renewal rights ever. Take a second. Which answer would you pick? The correct answer is A. No state guarantee fund protection. A is correct because excess line insureds must be warned that because the insurer is unauthorized, losses will not be protected by any New York State security or guarantee fund if the insurer becomes insolvent. This disclosure is mandatory. B is wrong because the warning does not say fire losses are uncovered. What an excess line policy covers depends on its terms. The required disclosure concerns the absence of guarantee fund backing, not a fire exclusion. C is wrong because an excess line insured can still file and pursue claims under the policy. The disclosure addresses what happens if the unauthorized insurer fails, not any inability to make a claim in the first place. D is wrong because the warning is not about renewal rights. It alerts the insured that the state insolvency fund will not stand behind the unauthorized insurer, which is a solvency protection issue rather than a renewal matter. When a New York broker places coverage with an unauthorized insurer, the buyer must be warned about a hidden risk that has nothing to do with the policy's terms. Excess line coverage is written by insurers not licensed in New York, chosen for risks the admitted market won't take. Because these insurers are unauthorized, they don't participate in the state's guarantee fund, so the broker must disclose that gap before the client buys. Normally, the guarantee fund stands quietly behind an admitted insurer, ready to pay claims if that insurer becomes insolvent. Strip away that backing, as excess line placement does, and the insured is left exposed directly to the unauthorized insurer's own solvency, with no state safety net to catch a failed claim. It's easy to misread this warning as something broader than it is. It does not mean fire losses are excluded. It does not mean claims cannot be filed. And it says nothing about renewal rights. What disappears the moment an insurer is unauthorized is simple: the guarantee fund. Coverage still applies and claims still get filed. The only thing missing is the state's promise to pay if the insurer itself collapses. Question 27. To win a sale, a producer offers to pay part of the customer's first premium out of the producer's own pockets, an inducement not stated in the policy. What is this practice? Your options are A. Twisting, B. Misrepresentation, C. Rebating, D. Commission sharing. Before I reveal it, which one do you think is right? The correct answer is C. Rebating. C is correct because rebating is offering a client something of value outside the policy terms, such as paying part of the premium to induce a purchase. New York prohibits this as an unfair trade practice. A is wrong because twisting is misrepresenting facts to push a policyholder into replacing existing coverage. The scenario involves a financial inducement to buy, not deception aimed at replacing a policy. B is wrong because misrepresentation is a false statement about policy terms or benefits. Here the producer states nothing false. The violation is the improper inducement, which the law treats as rebating. D is wrong because commission sharing involves splitting commissions between licensees and is permitted in limited ways. Paying part of a customer's premium to close a sale is an inducement, which is rebating. Rebating is one of the oldest prohibited practices in insurance sales, offering a customer something of value outside the policy to close the deal. Rebating means giving a customer something of value not stated in the policy as an inducement to buy or keep insurance. This can include paying part of the premium, cash, a share of the commission, or gifts beyond what the policy promises. Picture a producer handing cash to a customer outside the policy terms, sweetening the deal to close the sale. Even if the producer is completely truthful about the coverage, offering this off-policy value is still rebating. Rebating is often confused with other violations. Twisting is misrepresenting facts to push a policyholder into replacing coverage. Misrepresentation is a false statement about policy terms. Commission sharing is splitting commissions between licensees, which is permitted in limited ways. Rebating alone involves giving the customer value from outside the policy to induce the purchase. The clearest sign of rebating is value flowing to the customer from outside the policy, cash, premium payments, or gifts used as the hook to buy, regardless of whether anything false was said. Question 28. To establish negligence, an injured party must prove a legal duty, a breach of that duty, proximate cause, and one more element which completes the 4 required parts. Your options are A. Intent to harm, B. A written contract, C. A criminal conviction, D. Actual damages. What's your answer? Commit to one before I continue. The correct answer is D. Actual damages. D is correct because the 4 elements of negligence are a legal duty owed, a breach of that duty, proximate cause, and actual damages. If the injured party suffered no measurable harm, the negligence claim fails for lack of damages. A is wrong because intent to harm describes an intentional tort, not negligence, which involves carelessness rather than purpose. Negligence requires actual damages as its 4th element, not a showing that the defendant meant to cause harm. B is wrong because a written contract is not required to bring a negligence claim, which rests on a duty of care imposed by law. The missing 4th element is measurable damages, not any written agreement between the parties. C is wrong because a criminal conviction belongs to the separate world of crimes prosecuted by the state. Negligence is a civil wrong proven by duty, breach, proximate cause, and damages, none of which requires a conviction. Negligence law doesn't blame everyone connected to an accident. It only imposes liability when a specific set of elements is proven, and missing even one defeats the claim. To win a negligence claim, the plaintiff must prove 4 things: a legal duty, a breach of that duty, proximate cause linking the breach to harm, and actual damages. Duty, breach, and causation without measurable harm leave the claim incomplete because there's nothing to compensate. Picture a shopkeeper who leaves a hazard in an aisle, breaching the duty to keep the store safe. If a customer trips but walks away unharmed, there's duty, breach, and causation, yet no claim, because there are no actual damages. Add a real injury and the 4th element is satisfied. Wrong answers often borrow requirements from other areas of law. Intent to harm belongs to intentional torts, not carelessness-based negligence. A written contract isn't required, since duty comes from law, not agreement, and a criminal conviction belongs to a separate system of state-prosecuted crimes. Was a duty owed? Was it breached? Did it proximately cause something? And did that something amount to real, measurable harm? If the chain stops short of actual damages, the claim isn't complete. Question 29. A commercial package policy is built by bolting 2 universal forms onto 2 or more coverage parts that include at least 1 property and 1 casualty part, which describes that recipe. Your options are A. The package assembly structure, B. A monoline arrangement, C. An interline endorsement, D. A reporting form. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. The package assembly structure. A is correct because a package policy combines the common declarations and common conditions with 2 or more coverage parts, at least 1 property and 1 casualty. That assembly recipe is what distinguishes a true commercial package from a single line contract. B is wrong because a monoline arrangement provides only 1 line of commercial coverage standing alone. The question describes several parts joined under shared paperwork, which is the opposite of a single line policy. C is wrong because an interline endorsement modifies more than 1 coverage part at once. It is a piece bolted into the package, not the overall recipe by which the whole package is assembled. D is wrong because a reporting form adjusts limits, as the insured periodically reports change in values. It addresses how a single coverage tracks value over time, not how an entire package is put together. A commercial package policy isn't one contract, it's an assembly. Let's break down the exact formula the exam wants you to recognize. Every package starts with 2 universal forms, the common declarations and common conditions, sitting on top and applying to everything below. Beneath them, the insured stacks 2 or more coverage parts, and the mix must include both a property part and a casualty part. Picture the shared declarations and conditions sitting on top, applying to the whole contract, with a property part and a casualty part attached beneath them. That combination of shared paperwork plus 1 property and 1 casualty part is what makes it a genuine package. Don't confuse the package with its lookalikes. A monoline arrangement covers only 1 line alone. An interline endorsement modifies several parts at once, but isn't the overall recipe. And a reporting form just adjusts limits as values change over time. Whenever a question describes shared common forms combined with both property and casualty coverage parts, that pairing is the signal for a true commercial package policy. Question 30. New York requires virtually all employers to provide workers' compensation, and an employer who illegally fails to secure coverage faces serious consequences. Which statement describes New York's mandate? Your options are A. Coverage is purely optional. B. Coverage is compulsory for nearly all employers. C. Only large factories must carry it. D. Only public agencies must carry it. Which would you go with? Lock it in before the reveal. The correct answer is B. Coverage is compulsory for nearly all employers. B is correct because New York's workers' compensation law is compulsory. Nearly every employer with employees must secure coverage, and an employer that fails to do so loses exclusive remedy protection and exposes itself to penalties and lawsuits. A is wrong because calling coverage optional describes an elective state, which New York is not. Here, the statute forces nearly all employers to carry protection. So treating participation as a free choice misstates the law. C is wrong because limiting the duty to large factories ignores that headcount, and industry rarely excuse an employer. Small shops, offices, and most businesses with employees must carry coverage just as a big plant does. D is wrong because restricting the requirement to public agencies leaves out the private employers who make up the bulk of the mandate. Both public and private employers fall under the compulsory coverage obligation in New York. New York does not let employers opt out of workers' compensation. It is a legal requirement, not a choice. Employers can meet the mandate through a private insurer, the New York State Insurance Fund, or qualified self-insurance. But coverage itself is never optional, regardless of the business's size or industry. The system works because it's universal. Employees get guaranteed no-fault benefits, and in exchange, employers gain exclusive remedy protection from lawsuits, a bargain that only holds if virtually everyone participates. Picture the protection as a shield. As long as an employer secures coverage, that shield blocks employee lawsuits while still guaranteeing benefits for injuries. Skip the coverage, and the shield disappears, leaving the employer exposed to lawsuits and statutory penalties. So don't ask which employers must carry workers' comp. Assume nearly all of them do, and treat any exemption as the unusual case. Question 31. A New York insured already has a personal auto policy and buys a replacement car. To keep coverage on the new vehicle, what must the insured generally do? Your options are: A. Nothing. Coverage never transfers. B. Buy an entirely new policy first. C. Notify the insurer within the required time. D. Wait until the policy renews. Don't overthink it. Which one feels right? The correct answer is C. Notify the insurer within the required time. C is correct because A. Newly acquired auto is automatically covered for a limited grace period, but the insured must notify the insurer within the time the policy requires to keep coverage in force on the new vehicle. Prompt notice secures the coverage. A is wrong because coverage does extend automatically to a newly acquired auto for a short window, so saying it never transfers is wrong. The insured simply must report the new car within the required time to maintain it. B is wrong because buying a whole new policy is unnecessary because the existing policy extends to a newly acquired auto temporarily. The insured only needs to notify the insurer within the grace period, not start over. D is wrong because waiting until renewal can let the grace period lapse and leave the new car uninsured. The insured must report the vehicle within the policy's required time frame rather than waiting for the renewal date. When an insured buys a replacement car mid-policy, the auto policy doesn't leave that vehicle uninsured. It uses a built-in mechanism called the newly acquired auto provision, paired with a duty to notify. A newly acquired auto is automatically covered the instant the insured takes ownership, so there's no gap the moment it's driven off the lot. But that automatic coverage only lasts for a limited grace period. The insured must notify the insurer within the required time, and that notice is what turns temporary coverage into coverage that continues beyond the grace period. Picture a clock that starts ticking the moment the new car is acquired. Automatic coverage runs while that clock ticks, covering the grace period. Notice given before the deadline is what keeps coverage running afterward. Exam traps misstate this in 3 ways. Claiming coverage never transfers, claiming the insured must buy an entirely new policy, or claiming they can wait until renewal. All 3 are wrong because the existing policy already extends coverage automatically, and the real requirement is simply to notify the insurer within the required time. Automatic coverage gets the new car through the first days, but only prompt notice within the required period keeps that coverage in force. Question 32. An agent reviews coverages a client wants folded into one commercial package. Which of these cannot be included and must instead be written separately from the package? Your options are A. Commercial general liability, B. Workers' compensation, C. Commercial crime, D. Commercial inland marine. Got a guess? Lock it in. The correct answer is B. Workers' compensation. B is correct because workers' compensation cannot ride inside the commercial package. It is written separately, along with life and health coverage. The package accepts property and casualty lines, but excludes these specialized contracts from its assembly. A is wrong because commercial general liability is a core casualty part of the package and is routinely included. Far from being excluded, it often supplies the casualty line that makes the bundle a true package. C is wrong because commercial crime fits comfortably inside the package as a coverage part covering theft and dishonesty. The naming changes to a form, but the coverage is fully eligible for inclusion. D is wrong because commercial inland marine is commonly added to the package to cover movable or in-transit property. It is an eligible coverage part, so it is not the line that must be written on its own. The commercial package can hold many property and casualty coverages, but one major line is always excluded: workers' compensation. Workers' compensation, along with personal lines like life and health, sits outside the package because it's governed by its own statutory benefit system rather than ordinary contract terms. The package itself is reserved for core property and casualty coverage parts. General liability, commercial crime, and inland marine are all standard package parts, freely bundled together. Workers' compensation is the outlier, the one coverage that must always be written on its own. Because workers' compensation rates and benefits are set by state law and a specialized rating system, it can even be written through the New York State Insurance Fund, completely separate from the package. Remember, the package is flexible but not infinite. Workers' compensation always needs its own contract. Question 33. After a heavy upstate blizzard, the weight of accumulated snow caves in an insured's roof. This cause of loss is a broad form peril, so it is covered under which forms? Your options are A. The broad and special forms, B. The basic form only, C. No dwelling form, D. Only with a theft endorsement. Which one is it? Pause the video if you need more time. The correct answer is A. The broad and special forms. A is correct because weight of ice, sleet and snow is a broad form peril. It is covered under the broad form, and because that form is at least as broad on the dwelling, under the special form as well, but not on a bare basic form. B is wrong because the basic form covers only its automatic and extended coverage perils, which do not include weight of ice, sleet and snow. That peril first appears at the broad form level, so the basic form does not respond. C is wrong because the loss is covered, just not by every form. Weight of snow is a recognized broad form peril. Saying no dwelling form covers, it ignores that the broad and special forms both include it. D is wrong because a theft endorsement adds theft coverage and has nothing to do with snow load on a roof. The weight of snow is covered as a broad form peril, not through any theft-related add-on. Dwelling and homeowners coverage is built in tiers, and a peril is only covered by the forms that reach it. Let's see where the weight of ice, sleet, and snow actually enters that structure. The basic form covers only a short list of named perils, and snow load isn't one of them. The broad form adds more perils, specifically naming the weight of ice, sleet, and snow. The special form is open peril on the dwelling, covering all risks of direct physical loss except what's excluded. So it picks up the same peril by a different route. Picture a home near Syracuse where a blizzard piles snow on the roof until it caves in. That collapse is covered under the broad form and the special form, but not under a bare basic form. 3 traps to avoid: claiming the basic form covers it, claiming no dwelling form covers it, and claiming it needs a theft endorsement. None hold up. Since the broad and special forms both include this peril, and theft endorsements have nothing to do with snow load. So remember, the weight of ice, sleet, and snow enters the tiers at the broad form and rises into the open peril special form, while the bare basic form stays outside it. Question 34. An insurer supplies an agent with company stationery, applications, and signage, leading a customer to reasonably believe the agent can act for the insurer on a matter not actually authorized. This illustrates what? Your options are A. Express authority, B. Implied authority, C. Fiduciary authority, D. Apparent authority. Take a second. Which answer would you pick? The correct answer is D. Apparent authority. D is correct because apparent authority arises when an insurer's own conduct leads a reasonable third party to believe an agent has authority, even where actual authority is lacking. The company can be bound by that reasonable appearance. A is wrong because express authority is power. The insurer grants the agent directly in words. The scenario turns on appearances created by stationery and signage, not on a specific authorization for the act. B is wrong because implied authority is power reasonably necessary to carry out expressly granted duties. The point here is the impression given to the customer, which defines apparent rather than implied authority. C is wrong because fiduciary authority is not a standard agency category, since fiduciary describes a duty of trust. The reasonable appearance of authority created by the insurer is called apparent authority. Insurance runs on agents binding insurers, but one kind of authority comes from appearances, not from any grant the insurer actually made. That kind is apparent authority. Apparent authority arises when the principal's own conduct leads a reasonable third party to believe an agent has authority, even when actual authority is lacking. Because customers can't see private instructions, the doctrine places the risk of misleading appearances on the insurer that created them. Express authority is power the insurer grants directly in words. Implied authority is whatever is reasonably necessary to carry out that express grant. Fiduciary isn't a source of authority at all, it's just the duty of trust the agent owes. Apparent authority alone comes from the reasonable appearance the principal created, with no actual grant behind it. Picture an insurer that hands an agent company stationery, applications, and signage. A customer in the Hudson Valley, seeing all of it, reasonably believes the agent can act for the insurer, even on a matter the agent was never actually authorized to handle, because the insurer's own conduct created that reasonable impression. The company can be bound by the agent's act under apparent authority, regardless of what was actually authorized. Question 35. Every commercial package policy opens with 2 general forms that apply no matter which lines the insured buys. These 2 universal forms are the common declarations and which other form? Your options are A. The causes of loss form, B. The common policy conditions, C. A commercial inland marine floater, D. The crime coverage form. Before I reveal it, which one do you think is right? The correct answer is B, the common policy conditions. B is correct because every package begins with the common policy declarations and the common policy conditions. The conditions state the housekeeping rules, routed through the first named insured, that apply uniformly across all coverage parts in the package. A is wrong because the causes of loss form belongs only to the commercial property part, stating which perils apply. It is a line-specific piece, not one of the two universal forms heading the whole package. C is wrong because a commercial inland marine floater is one optional coverage part among many. The insured selects it only if needed, so it cannot be a form that appears in every package. D is wrong because the crime coverage form addresses theft and dishonesty exposures for businesses that choose it. It is a coverage part the insured may add, not a general form, opening every commercial package. Every commercial package always opens with two general forms, no matter which coverages the insured selects. The common policy declarations record the variable facts of the risk, while the common policy conditions supply the housekeeping rules that apply uniformly across every coverage part. These conditions gather the shared rules in one place: cancellation, changes, examination of books and records, inspections, transfer of rights and duties, and the authority of the first named insured. The first named insured is the party listed first on the declarations, acting as the single point of contact, receiving and giving notices, requesting changes, and speaking for all insureds in administrative matters. By centralizing these rules, the common policy conditions keep the entire package coherent, so cancellation and other administrative actions always route through the first named insured. Question 36. For a valuable antique, the insured and insurer set a figure before issuance, and that exact amount is guaranteed to be paid if a total loss occurs. Which valuation method is this? Your options are A. Agreed value, B. Stated amount, C. Actual cash value, D. Functional replacement cost. What's your answer? Commit to one before I continue. The correct answer is A. Agreed value. A is correct because agreed value fixes the property's worth before the policy is issued, and that agreed figure is guaranteed at a total loss, with no depreciation argument. Its defining feature is the guarantee of the stated number. B is wrong because stated amount also lets the insured set a value, but it is not guaranteed. At loss, the insurer pays the lesser of the stated figure or actual cash value. The guarantee in this question points to agreed value. C is wrong because actual cash value pays replacement cost today, minus depreciation, and is the default for ordinary property. It reduces the payment for wear and never guarantees a preset figure the way agreed value does. D is wrong because functional replacement cost pays to replace property with a functionally equivalent, often more modern item. It addresses how to rebuild practically, not the preset guaranteed figure described here. Most property is insured on a depreciated or current worth basis, but hard-to-value items need something different, a value fixed in advance and guaranteed if the item is destroyed. That method is agreed value. Insured and insurer agree on the property's worth before the policy is issued, and that guarantee is the defining feature. At a total loss, the insurer pays exactly that figure. No depreciation, no argument. It's built for antiques, fine art and collectibles whose value is hard to prove after a loss. Picture an insured antique in a Westchester home. The insured and insurer set its value before the policy issues. If it's destroyed, the insurer pays that exact agreed figure without reducing it for depreciation or fighting over its worth. Stated amount also lets the insured set a figure, but it's only a ceiling. The insurer pays the lesser of that figure or actual cash value. Actual cash value pays replacement cost minus depreciation, and functional replacement cost pays for a functionally equivalent modern item. None of these guarantee a preset figure the way agreed value does. The decisive clue is the guarantee. If the preset value is promised in full at a total loss, it's agreed value. If it's just a cap or subject to depreciation, it isn't. Question 37. A clerical worker at an agency answers phones, files paperwork, and accepts premium payments but never discusses coverage terms or recommends policies. Under New York law, this worker generally needs what? Your options are A. A temporary producer license, B. A consultant license, C. An adjuster license, D. No producer license. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is D. No producer license. D is correct because purely clerical work that does not involve selling, soliciting, or negotiating insurance falls outside the licensing requirement. Because the worker never discusses terms or recommends coverage, no producer license is required. A is wrong because a temporary license lets a qualified person act as a producer for a limited time, such as after an agent's death. The clerical duties here never rise to producer activity in the first place. B is wrong because a consultant license authorizes giving paid insurance advice. The worker offers no advice and only handles administrative tasks, so this license would not match the duties described. C is wrong because an adjuster license covers investigating and settling claims. Taking payments and filing paperwork is not claims work, so adjuster licensing has no bearing on this clerical role. Not every insurance office job requires a producer license. Licensing attaches only to specific activities, and a purely clerical worker who never performs them stays outside that requirement. A producer license is required only to sell, solicit, or negotiate insurance. Selling exchanges the contract, soliciting persuades someone to buy, and negotiating discusses terms toward a purchase. Picture a clerical worker answering phones, filing paperwork, and accepting premium payments, never discussing coverage or recommending a policy. Because none of those duties involve selling, soliciting, or negotiating, no producer license is required. Each distractor license addresses an activity the clerk doesn't perform. A temporary producer license covers acting as a producer, a consultant license covers paid advice, and an adjuster license covers claims work. None of these match purely clerical duties. The moment a worker starts advising on coverage or steering a sale, licensing kicks in. Until then, phones, files, and payments alone never cross the line. Question 38. An insured asks about flood coverage for a home near a low-lying creek in the Hudson Valley. The standard dwelling and homeowners policies treat the flood peril how? Your options are A. They fully cover flood. B. They cover flood only at night. C. They exclude flood. D. They cover flood without limit. Which would you go with? Lock it in before the reveal. The correct answer is C. They exclude flood. C is correct because standard dwelling and homeowners policies exclude the flood peril. Flood coverage is instead obtained through the National Flood Insurance Program, a federal program administered by the Federal Emergency Management Agency for participating communities. A is wrong because full flood coverage is exactly what these policies do not provide. The exclusion is why a separate federal flood program exists for owners who need protection against rise in water. B is wrong because there is no time of day condition on flood coverage. The peril is simply excluded outright, regardless of when flooding occurs, leaving the federal program as the route to coverage. D is wrong because unlimited flood coverage is not offered by standard property policies, which exclude the peril entirely. Even the federal flood program caps coverage at statutory maximums rather than providing unlimited protection. Standard homeowners and dwelling policies leave out one costly peril entirely: Flood, forcing owners to look elsewhere for that protection. These policies simply do not cover rising water, surface water, overflow of a body of water, or similar inundation, no matter the circumstances. Picture a home near a low-lying creek in flood-prone terrain. When the creek overflows, rising water and surface water inundate the property. Exactly the peril the standard policy excludes. Exam traps often claim these policies fully cover flood, cover it only at night, or cover it without limit. All three misstate a categorical exclusion capped even under the federal program. Remember, the standard policy excludes flood outright, and coverage comes only through the National Flood Insurance Program, subject to its statutory caps. Question 39. In the agency relationship that lets an agent bind coverage, the insurer that grants authority and is bound by the agent's authorized acts plays which role? Your options are A. The agent, B. The third party, C. The fiduciary, D. The principal. Don't overthink it. Which one feels right? The correct answer is D. The principal. D is correct because in agency law the insurer is the principal, granting authority to the agent and becoming bound by the agent's authorized acts. The agent represents the principal in dealings with applicants and insureds. A is wrong because the agent is the party who acts on the principal's behalf, not the one granting authority. The question asks about the insurer that confers authority, which is the principal. B is wrong because the applicant or insured is the third party in this relationship, dealing with the agent. The insurer that empowers the agent is the principal, not the outside party to the agency. C is wrong because fiduciary describes a duty of trust an agent owes, not the insurer's role as the source of authority. The insurer granting and being bound by that authority is the principal. Agency law assigns each party a specific role, and this scenario tests whether you can name the one who grants authority and bears its consequences, the principal. Three roles define every agency relationship. The principal grants authority, the agent exercises it, and the third party deals with the agent from outside. In insurance, the insurer is the principal, the agent binds coverage, and the applicant or insured is the third party. Picture the binder an agent signs to bind coverage. It names the insurer as principal, carries the agent's signature, identifies the applicant as third party, and cites the authority the insurer granted. That authority's legal force always traces back to the insurer. Don't confuse the roles. The agent acts on the principal's behalf, but doesn't grant authority. The third party is the outside applicant or insured, and fiduciary describes the agent's duty of trust to the principal, not a role of authority itself. Remember, the principal is the source of authority and the one who answers for the agent's authorized acts. Question 40. A policy protecting trustees and administrators who manage an employer's pension and employee benefit plans against liability for violating federal benefit plan duties is best described as what? Your options are A. Fiduciary liability insurance, B. A fiduciary surety bond, C. Errors and omissions insurance, D. Workers' compensation. Got a guess? Lock it in. The correct answer is A. Fiduciary liability insurance. A is correct because fiduciary liability insurance protects those who manage private pension and employee benefit plans against liability for breaching their duties under the federal benefit plan law. It responds to claims of imprudent investment or plan mismanagement. B is wrong because a fiduciary surety bond is a court bond guaranteeing a guardian, executor, or trustee will faithfully handle entrusted assets. It is a surety guarantee, not insurance covering benefit plan management liability. C is wrong because errors and omissions insurance covers professionals such as agents or accountants for service errors. It is not the specialized form addressing breaches of duty by managers of employee benefit plans. D is wrong because workers' compensation pays statutory benefits to employees injured on the job, replacing the employer's tort liability for workplace harm. It has nothing to do with protecting plan administrators against liability for mishandling pension and benefit plan assets. Some professionals don't just perform a service. They manage other people's money and benefits under duties imposed by federal law. Fiduciary liability insurance covers the personal exposure that comes with breaking those duties. Federal benefit plan law holds plan trustees and administrators to strict standards of prudence and loyalty. If they breach those duties, say by investing plan assets imprudently, they face personal liability, and this coverage defends them and pays the resulting liability. Picture trustees managing an employer's pension plan in Albany, accused of imprudently investing plan assets in violation of their federal duties. Fiduciary liability insurance responds by defending the trustees and covering the liability from that alleged breach. A surety bond guarantees a guardian or trustee will faithfully handle assets. It's a promise against theft, not insurance against a breach of duty claim. Errors and omissions covers professionals like agents or accountants for service mistakes, and workers' compensation pays injured employees. Neither touches plan fiduciary exposure. When a trustee or administrator is accused of mismanaging or imprudently investing plan assets, that breach of federal fiduciary duty is the unmistakable signal for fiduciary liability insurance. Question 41. On a claims-made liability policy, a date in the declarations marks the earliest point in the past from which injuries will be covered. What is this date called? Your options are A, the expiration date, B, the anniversary date, C, the retroactive date, D, the discovery date. Which one is it? Pause the video if you need more time. The correct answer is C, the retroactive date. C is correct because the retroactive date is entered in the claims made declarations and marks the earliest point from which injuries are covered. Anything occurring before that date is excluded, no matter when the claim was eventually made. A is wrong because the expiration date is when the policy term ends. It marks the close of coverage, not the backward reaching point that determines how far into the past injuries remain covered. B is wrong because the anniversary date marks a yearly point in a multi-year term for review or adjustment. It does not define the earliest covered occurrence under a claims made form. D is wrong because a discovery date refers to when a crime loss is found under crime coverage. It has no role in fixing the earliest covered injury under a claims-made liability policy. Liability policies decide coverage using one of two clocks, and claims-made policies pair theirs with a special date that limits how far back protection reaches. An occurrence policy covers harm from the moment it happens, even if the claim surfaces years later. A claims-made policy instead covers claims first reported while the policy is active, and the retroactive date acts as its backstop against stale, unpriced conduct. Picture a horizon line in the insured's past, the retroactive date, injury occurring on or after that line, and first claim during the policy period is covered. Anything before the line is excluded, no matter when the lawsuit lands. Don't confuse the retroactive date with three lookalikes. The expiration date closes the forward edge of the term. The anniversary date marks a yearly checkpoint, and the discovery date belongs to crime coverage, fixing when a loss is found. Only the retroactive date measures how far back a covered injury may have occurred. Keep that date fixed across renewals, and slow developing claims stay protected. Question 42. Two Albany contractors share the same job classification, yet one has far fewer claims. New York lowers the safer contractor's premium below the manual level using which adjustment? Your options are A. A premium discount, B. The experience modification factor, C. A policy dividend, D. A surplus lines fee. Take a second. Which answer would you pick? The correct answer is B. The experience modification factor. B is correct because the experience modification factor adjusts manual premium up or down based on the individual employer's own loss history. A better than average record produces a factor below 1, lowering the safer contractor's premium. A is wrong because a premium discount is based on the size of the premium, reflecting economies of scale, not the employer's claims record. It rewards large accounts, not the contractor's superior safety performance. C is wrong because a dividend is a possible return of premium declared after the policy period if results are favorable. It comes later and is not guaranteed, unlike the experience factor applied when the premium is set. D is wrong because a surplus lines fee relates to placing coverage with an unauthorized insurer for hard-to-place risks. It has nothing to do with rewarding a workers' compensation insured for a clean loss history. Workers' compensation pricing starts out impersonal, billed for an entire class of similar business instead of one specific company. That uniform starting point is called the manual rate. The manual rate ignores how any single employer actually performs, charging the same number whether a business runs safely or racks up claim after claim. That uniformity is exactly what creates the unfairness the experience mod is built to fix. A factor below 1 means better than expected losses and shaves the premium down. A factor of exactly 1 means the employer matches the class average. A factor above 1 means worse than expected losses and loads the premium up. The mechanism compares an employer's actual losses against the losses expected for a business of its size and class. That comparison produces the mod factor, which either credits or debits the manual premium. Only the experience mod ties premium to an individual employer's safety record. A premium discount just rewards sheer account size. A dividend is a possible refund declared after the policy ends. And a surplus lines fee belongs to placing hard-to-insure risks with unauthorized insurers. Question 43. Under the business owner's liability coverage, how are defense costs treated in relation to the limit of insurance? And when does the duty to defend end? Your options are A. They reduce the limit immediately. B. They are capped at a flat amount. C. They fall under the aggregate only. D. Paid extra until the limit exhausts. Before I reveal it, which one do you think is right? The correct answer is D. Paid extra until the limit exhausts. D is correct because defense costs are paid in addition to the limit and do not reduce it. But the duty to defend ends once the applicable limit is exhausted by payment of judgments, settlements, or medical expenses. Both facts are tested together. A is wrong because defense costs do not reduce the limit immediately. They are paid on top of it. Saying they erode the limit reverses the rule that defense is outside the limit until it is spent. B is wrong because defense costs are not capped at a flat amount under the liability coverage. The form pays defense in addition to the limit rather than subjecting it to a fixed dollar ceiling. C is wrong because defense costs are not confined to the aggregate. They are paid in addition to the limit as the suit is handled. Tying them solely to the aggregate misdescribes how defense is funded. Business owner's liability coverage hides two separate rules inside one provision, where defense costs sit, and when the duty to defend runs out. Defense costs are paid in addition to the limit of insurance, So hiring lawyers and litigating a suit never shrinks the money available for a judgment or settlement. But that duty to defend isn't endless. It continues only until payments of judgments, settlements, or medical expenses exhaust the limit. Picture the limit of insurance as a separate pool from defense spending. The insurer funds the defense outside that pool, keeping it fully intact for the claim itself. As judgments, settlements, and medical expense payments chip away at the limit, the duty to defend keeps going until the limit finally runs dry. Exam traps distort one half of this pairing, saying defense costs reduce the limit, capping defense at a flat dollar amount, or claiming defense falls under the aggregate only. None of these match how the business owner's form actually works. Remember it as one leash, defense is paid outside the limit. But the moment payments exhaust that limit, the duty to defend switches off. Question 44. A client asks that a piece of jewelry be scheduled and an excluded peril be bought back on her policy. The attached document that adds or changes coverage this way is called what? Your options are A declaration, B, a binder, C, an endorsement, D, a certificate. What's your answer? Commit to one before I continue. The correct answer is C, an endorsement. C is correct because an endorsement, sometimes called a rider, is a document attached to the policy that adds, deletes, or modifies coverage. Scheduling jewelry or buying back an excluded peril is done by endorsement. A is wrong because the declarations record the variable facts of the risk, such as the insured, the limits, and the premium. They display particulars rather than serving as the tool that adds or changes coverage terms. B is wrong because a binder is temporary evidence of coverage issued while a policy is finalized. It provides interim protection and does not permanently schedule property or restore an excluded peril. D is wrong because a certificate of insurance summarizes existing coverage for a third party. It evidences a policy already in force and cannot itself add coverage or modify the contract's terms. Insurance policies are printed for the common case, but every risk is unique. The tool that customizes a standard form without rewriting it is called an endorsement. An endorsement, sometimes called a rider, attaches to a policy and changes what the base contract says. It can add coverage, delete coverage, modify a limit, or schedule a specific item of property. Picture the base form as the standard contract, with an endorsement attached that schedules a valuable item or buys back an excluded peril, changing exactly what's covered. The base form stays filed and approved, while the endorsement documents the change. 3 lookalikes cause confusion. The declarations simply record the facts of the risk. A binder offers temporary evidence while the policy is finalized. And a certificate summarizes existing coverage for an outsider. Only the endorsement actually changes the contract's substance. When a document adds, deletes, or reshapes what a policy covers, that's an endorsement at work. Everything else just describes, evidences, or reports on coverage already in force. Question 45. Outside of no fault, the personal auto policy includes a part that pays reasonable medical and funeral expenses for the insured and occupants, regardless of fault. Which part is that? Your options are A. Part A, liability, B. Part B, medical payments, C. Part C, uninsured motorists, D. Part D, damage to your auto. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Part B, medical payments. B is correct because Part B, medical payments, pays reasonable and necessary medical and funeral expenses for the insured and occupants injured in an auto accident, regardless of fault. In New York, much of this role is filled by mandatory no-fault coverage. is wrong because Part A pays for bodily injury and property damage the insured causes to others based on legal liability. It is third-party liability coverage, not first-party medical payments for the insured and the car's occupants. C is wrong because Part C protects the insured against uninsured or underinsured at-fault drivers. It responds when another driver lacks adequate coverage, not as a no-fault medical benefit for the insured's own occupants. D is wrong because Part D pays for physical damage to the insured's own covered auto. It covers the vehicle, not the medical and funeral expenses of injured people, which fall under the medical payments part. Every personal auto policy has a first-party medical benefit hiding just beneath the no-fault system. It's called Part B, medical payments coverage. Part B pays reasonable medical and funeral expenses for the insured and the occupants of the insured's own covered auto, and it does so without asking who was at fault. It's a first-party benefit that exists to move money to injured people quickly. Picture a single car sliding on an icy road. The insured loses control and a passenger is hurt. There's no other driver to blame, yet Part B still pays the passenger's medical expenses because fault was never the question. Compare the four parts of the policy. Part A is liability, paying third parties based on fault. Part B is medical payments, paying the insured's own side regardless of fault. Part C responds when the other driver lacks coverage, and Part D pays for damage to the insured's own vehicle. Whenever a question describes medical and funeral expenses paid to the insured and passengers without any fault requirement, think Part B, medical payments coverage. Question 46. A shopper hurt in a Buffalo store has her reasonable medical bills paid by the business owner's medical expenses coverage regardless of fault. This medical coverage is best described as what? Your options are a no-fault medical payments coverage, B, liability damages coverage, C, workers' compensation coverage, D, personal injury protection. Which would you go with? Lock it in before the reveal. The correct answer is A, no-fault medical payments coverage. A is correct because the business owner's medical expenses coverage pays reasonable medical bills for accidental bodily injury on a no-fault basis, without regard to the insured's legal liability, provided the expenses incurred and reported within 1 year of the accident. B is wrong because liability damages coverage pays only when the insured is legally obligated to pay. The medical payments coverage responds without proving fault, which distinguishes it from fault-based liability damages. C is wrong because workers' compensation covers work-related injuries to the insured's own employees. The injured party here is a shopper, and employee injuries are specifically excluded from medical payments. D is wrong because personal injury protection is an auto no-fault benefit for vehicle-related injuries. The business owner's medical payments coverage is a premises and operations benefit, not an auto coverage. Behind this quiz answer sits a small but important benefit in the business owner's policy: no-fault medical payments coverage, a payment that flows to an injured visitor without anyone arguing about blame. The coverage pays reasonable medical bills for an accidental injury connected to the premises or operations, so long as the expense is incurred and reported within 1 year. And critically, no finding of negligence is ever required. Picture a shopper who trips inside a store in Buffalo. Whether the store was negligent never has to be resolved, because as long as the injury happened on the premises and the bill is reported within a year, the coverage simply pays. Liability damages coverage pays only after fault is proven, the opposite of this benefit. Workers' compensation covers injured employees, not the public. Personal injury protection is an auto no-fault benefit, not a premises one. Only no-fault medical payments coverage combines no-fault, a medical benefit, a member of the public, and a premises and operations trigger. Whenever a stem describes paying a hurt visitor's medical bills regardless of legal liability, that's the signature of no-fault medical payments coverage. Question 47. An upstate furnished house is left empty of people for the winter while all the furniture remains inside. In coverage terms, this building is best described as what? Your options are A. Vacant, B. Abandoned, C. Condemned, D. Unoccupied. Don't overthink it. Which one feels right? The correct answer is D. Unoccupied. D is correct because a building is unoccupied when the contents remain but no people are present, such as a snowbird's furnished home left for the winter. Mere unoccupancy generally does not cost the insured any coverage. A is wrong because vacant means the building contains neither people nor contents, standing entirely empty. Because the furniture remains here, the home is unoccupied rather than vacant, and the riskier vacancy penalties do not apply. B is wrong because abandoned describes property the owner has given up with no intent to return. The owners plan to come back after winter and left their belongings, so the home is simply unoccupied, not abandoned. C is wrong because condemned means a public authority has declared the building unfit for use. Nothing here indicates a government order. The house is merely empty of people for the season, which is unoccupied. Insurance policies draw a sharp line between two words that sound almost the same, but carry very different consequences: unoccupied and vacant. A building is unoccupied when the people are gone, but the furniture and belongings remain. Because the contents are still there, the dwelling still functions like a lived-in home. So standard coverage generally holds with no penalty. Picture a furnished house in the Adirondacks, locked up for the winter while the owners head south. The rooms are still full of furniture, the door is locked, and the owners fully intend to return. So the house is unoccupied, not vacant. Three other words often get confused with unoccupied. Vacant means neither people nor contents remain. Abandoned means the owner never intends to come back. Condemned means a government authority declared the building unfit for use, none of which describes a seasonal closure. Always check the contents first and intent second. People gone, contents present, and a plan to return means unoccupied, and coverage stays intact. Question 48. An insurer organized under the laws of another country sells coverage in New York. Relative to New York, how is this insurer classified? Your options are A. An alien insurer, B. A foreign insurer, C. A domestic insurer, D. A non-admitted insurer. Got a guess? Lock it in. The correct answer is A. An alien insurer. A is correct because an alien insurer is one organized under the laws of a country other than the United States. The classification is based on where the company is formed, viewed from the state where it operates. B is wrong because a foreign insurer is organized under the laws of another United States state, not another country. The company in the question comes from abroad, which makes it alien rather than foreign. C is wrong because a domestic insurer is one organized under the laws of the state in question, here New York. A company formed in another country cannot be domestic to New York. D is wrong because non-admitted describes an insurer without a certificate of authority, regardless of where it was formed. The question asks about place of formation, which determines the alien classification. New York sorts every insurer into one of three buckets based on a single fact: where the company was formed. That origin label is completely separate from where it sells coverage or how big it is. A domestic insurer is chartered right there in New York. A foreign insurer is chartered under the laws of a sister U.S. state. An alien insurer is chartered under the laws of another country entirely. no matter how much business it does in New York. Picture a map, a company chartered in New York, one chartered in a sister state, and one chartered overseas, all selling insurance into New York. Only the overseas one earns the label alien, regardless of how established it is here. This matters because regulators use origin as shorthand for who supervises a company's solvency, while a separate pair of labels, admitted and non-admitted, answers whether it holds a certificate of authority. Mixing these two axes is the classic trap exam questions are built around. Whenever a question describes a company organized under the laws of another country, the answer is alien, full stop, because origin and authorization are always separate questions. Question 49. A producer wants to conduct insurance business under a trade name different from the producer's legal name. Before using that name with the public, New York requires the producer to do what? Your options are A. Form a new corporation. B. File the assumed name with the department. C. Obtain a separate consultant license. D. Nothing. Trade names are unrestricted. Which one is it? Pause the video if you need more time. The correct answer is B. File the assumed name with the department. B is correct because a producer using a trade or assumed name must file it with the department so the regulator and the public can connect the name to the licensed person or entity standing behind it. A is wrong because using a trade name does not force the producer to incorporate. A sole proprietor or existing entity may adopt an assumed name once it is properly filed, without creating a new corporation. C is wrong because a consultant license authorizes paid advice and is unrelated to operating under a trade name. Filing the assumed name, not adding a license type, is what the law requires here. D is wrong because trade names are not unrestricted. Using one without filing can mislead the public about who stands behind the business. New York requires the assumed name to be reported before use. New York lets producers do business under a catchy trade name instead of their legal name, but only after clearing one required step. Before using it publicly, the producer must file the assumed name with the Department of Financial Services. This filing links the public-facing name to the license behind it, without creating a new license or a new legal entity. Think of the trade name as a name tag worn over a badge. The public sees the name tag, but the filing lets regulators peek underneath to see exactly which licensed person or entity is really there. This is why the filing matters. It ties the licensed producer to the trade name displayed on the door, so the department and the public can always trace the brand back to who is accountable. Don't overthink it. Filing an assumed name doesn't require forming a new corporation, and it isn't the same as needing a separate consultant license. It's also not unrestricted. Using an unfiled name risks misleading the public. The rule is simple. File the name, then use it. Question 50. The special form dwelling policy treats the building and the contents differently. Which statement correctly describes how it covers each? Your options are A. Open peril on building and contents. B. Basic peril on the building. C. Open building, broad named contents. D. Name building, open contents. Take a second. Which answer would you pick? The correct answer is C. Open building, broad named contents. C is correct because the special form gives open peril coverage on the dwelling and other structures and broad named peril coverage on personal property. Contents are never open peril under this form. They follow the broad named peril list. A is wrong because the special form is open peril only on the dwelling and other structures, not on personal property. Contents revert to broad named peril coverage, so describing both as open peril is incorrect. B is wrong because the building under the special form is open peril. covering all risks of direct physical loss except exclusions, not merely basic perils. Basic peril coverage would dramatically understate the special form's breadth on the dwelling. D is wrong because the structure is reversed. The building is open peril and the contents are broad, named peril. Saying the building is named peril and contents are open peril inverts how the special form actually works. The special form is famous for breadth, but that breadth isn't applied evenly. The exam hinges on knowing exactly where the broad coverage stops. The dwelling and other structures get open peril coverage. Everything is covered unless a cause is specifically excluded. Personal property gets broad named peril coverage instead. It's covered only if the cause appears on the named list. Picture one home. The dwelling and other structures are tested against open peril coverage, while everything inside, the personal property, is tested against the broad name peril list. Same policy, same loss event, 2 different coverage tests. 3 wrong framings trip candidates up. Calling both the building and contents open, peril overstates contents coverage. Calling the building basic peril understates it. And swapping the 2 inverts the form entirely. Fix this asymmetry in mind. Open peril stops at the structure, and the contents always follow the named peril schedule. No exceptions. And that's a wrap on today's New York Property and Casualty question review. Want to keep practicing? Our website is packed with free questions and complete study guides, all designed to help you prepare thoroughly for your exam. Whether you're just getting started or brushing up right before test day, you'll find something useful there. Simply follow the link in the description below to get started today. Hit subscribe to catch the next video in this series, and good luck.